$10,000 hidden under a mattress in the year 2000 would buy you less than $6,000 worth of life today. You didn't lose a single bill. Every note is still there. But almost half of what that money could do quietly disappeared. This is the slowest, most reliable way to go broke, and almost nobody notices it happening because the number in your account never goes down. Today we're going to make the invisible visible. What inflation really is, why it punishes savers, and the handful of things that have actually beaten it for 200 years. Start with what inflation actually means, because prices going up hides the real story. Prices aren't rising at random. Your money is losing its power to buy. Picture two columns. On one side, the dollars in your account. On the other, the things they can purchase. Groceries, rent, gas, a night out. Inflation is the slow drift of the second column away from the first. The dollars stay still. The life they buy keeps getting more expensive. It works exactly like a tax you never voted for, except it isn't taken from your paycheck. It's taken from your savings, a little every year, quietly, forever. Why does it happen at all? Mostly because the supply of money grows faster than the supply of real things to buy. When there are more dollars chasing the same goods, each dollar is worth a little less. Some inflation is normal and even intended. Central banks aim for a small, steady amount. The danger isn't the existence of inflation. It's that most people leave their money somewhere it can't keep up. Here's what it actually looks like over time. This is the buying power of a single dollar since 1970. Notice it only ever moves in one direction, down. A dollar today buys what about 15 cents bought back then. The bill in your wallet didn't change, the ground underneath it moved. And this is the official, relatively calm measure. Anyone who's bought a house, a car, or a college education knows the real-world drift can feel even steeper. Which brings us to the trap. The safest feeling thing you can do, leaving money in cash or a basic savings account, is quietly one of the riskiest things you can do with it. The average savings account pays a fraction of a percent, while inflation runs several times higher. Subtract one from the other, and your safe money is earning a negative real return. It's shrinking in slow motion. Safe from a crash, yes, but not safe from slowly losing. A small emergency cushion in cash is smart. A life savings sitting in cash is a slow leak. And inflation doesn't stay polite and predictable. Some decades it simmers in the background. Some decades it burns. In the 1970s, it averaged over 7% a year. Money was losing roughly half its value in about a decade. More recently, we watched it spike again and remind everyone it never really left. You can't time these surges. You can't predict them. You can only build a portfolio that's already prepared for them. Let me make this concrete with two people. Imagine twins, both 25, both setting aside the same amount every month for 30 years. The first keeps it all in a savings account because it feels safe. The second puts the same money into a broad index of the stock market and simply never touches it. 30 years later, the first twin has roughly what they put in, plus a sliver of interest. But after inflation, that pile buys barely more than the day they started. They protected the number and lost the value. The second twin rode every scary headline, every crash, every "this time it's different," and on paper watched their balance fall by a third more than once. But they didn't sell. They didn't flinch. And over 3 decades, their money didn't just keep up with inflation, it multiplied several times over in real, spendable terms. Same income, same discipline, same monthly habit. The only difference was where the money lived, and that single choice was worth more than any raise, any side hustle, any budgeting trick either of them ever tried. That's the part almost nobody internalizes until it's late. The biggest financial decision of your life usually isn't how much you earn or how carefully you cut coupons. It's whether your savings are quietly shrinking or quietly compounding while you sleep. The thief never rests, but neither does ownership. So how do you actually win this game? You can't outsave inflation by hoarding dollars, because the dollars themselves are what's shrinking. The only way to win is to own things that grow faster than money loses value. Over 2 full centuries, the pattern is remarkably stubborn. Stocks have beaten inflation by a wide margin. Bonds beat it more modestly. Gold roughly keeps pace. And cash, holding the dollar itself, slowly loses. The lesson written across 200 years of data is simple. Ownership wins. Sitting still loses. Let's break down why. Stocks are not lottery tickets. They're ownership stakes in real businesses. And businesses have a superpower against inflation. When their costs go up, they raise their own prices too. Their revenues and profits tend to rise right along with the cost of living, which means your slice of those profits rises too. That's why a simple broad index of the entire market has, for a century, grown wealth faster than inflation, more reliably than anything else an ordinary person can buy. No stock picking, no timing, just owning the whole thing and waiting. Real estate works on a similar logic. Rents tend to climb with the cost of living, and property values tend to follow over time. There's even a hidden bonus. If you borrow at a fixed rate, inflation quietly shrinks the real weight of that debt every year. You pay it back with dollars that are worth less than the ones you borrowed. But here's the catch nobody likes to say out loud. Every one of these, stocks, real estate, even gold, beats inflation only over long horizons, and only if you can stomach the drops along the way. In any single year, they can fall hard, sometimes brutally. The price of beating a patient thief is that you have to be patient too. The people who lose aren't usually the ones who picked the wrong asset. They're the ones who panicked and sold at the bottom, or who sat in cash for years waiting for the perfect moment that never came. So what does this actually mean for you? 3 simple moves. First, hold enough cash for emergencies, and not much more. Cash is a seatbelt, not an engine. Second, put money you won't need for years into productive assets that have historically outpaced inflation. A broad market index is the classic starting point. Third, do it consistently and automatically, and then leave it alone. Automate the boring part so your emotions never get a vote. You don't beat inflation with one clever trade. You beat it with ownership and time. Inflation is the quiet thief that never clocks out. It will keep working against you whether you pay attention or not. But the moment your money is working too, growing in things that rise with the world instead of sitting still while the world passes them by, the thief starts losing. That's the entire game. Make your money move, give it time, and let 200 years of history do the heavy lifting. If this made the invisible visible, subscribe. Every week we break down one more piece of how money really works. This is educational, not financial advice. Now go put your money to work.